transparency problem. Executive pay is highly scrutinized because it must align the interests of the principals, shareholders, with the agents, executives. Base salary. Usually a smaller portion of the total package to keep fixed costs lower. Annual incentives. Focused on short-term goals, for example, meeting annual EBITDA targets. Long-term incentives. Usually in the form of stock options, restricted stock units, RSUs, or performance shares. These typically have a 3 to 5 year vesting period to encourage long-term decision-making. Perquisites, perks. Relational or status rewards, such as company cars, club memberships, or executive physicals. Golden parachutes. Large payments made to executives if they are terminated following a merger or acquisition. Clawback provisions. Policies that allow a company to claw back bonuses if financial results are later found to be fraudulent or inaccurate, mandated for some by Dodd-Frank Act. In executive compensation, golden benefits are high-stakes financial arrangements designed to attract, retain, or provide a soft landing for top-tier leadership. While they all sound similar, they serve very different strategic purposes within a total rewards package. Golden parachute. A golden parachute consists of significant benefits, pay, stock options, or bonuses guaranteed to an executive if their employment is terminated following a change in control, such as a merger or acquisition. The goal? To ensure the executive remains objective during a merger. If they know they have a financial safety net, they are less likely to resist a buyout that is good for shareholders but might cost them their job. The trap. Under IRS, if a parachute payment is considered excessive, typically exceeding $3 times the executive's average annual compensation, the company loses its tax deduction, and the executive faces a 20% excise tax. Golden handcuffs are a collection of financial incentives intended to keep a high-performing employee from leaving for a competitor. These are deferred rewards that the employee loses if they resign before a certain date. Common tools, vesting schedules, stock options, or restricted stock units that only become the employee's property after 3 to 5 years of service. Deferred compensation. Large bonuses that are paid out in installments over several years. The goal. Retention of institutional knowledge. It makes it too expensive for the employee to quit. Golden handshake. A golden handshake is a generous severance package offered to an executive upon their departure, whether that departure is due to retirement, a layoff, or sometimes even a firing, to avoid a messy legal battle. Difference from a parachute. A handshake can happen at any time and does not require a merger or acquisition to trigger it. The goal. To encourage an executive to retire gracefully or to ensure a smooth transition without a lawsuit. Golden hello, signing bonus. This is an upfront payment given to an executive to induce them to leave their current employer and join a new firm. The goal. To compensate the executive for any golden handcuffs, unvested stock or bonuses they are leaving behind at their old company. It effectively buys out their loyalty to their previous employer. Golden boot. A golden boot is a variation of the handshake, but it is often more coerced. It is an incentive package offered to an older or high-earning executive to encourage them to take early retirement. The goal. To reduce payroll costs or open up bottleneck positions for younger talent without the PR disaster of a standard layoff. Term. Trigger event. Primary goal. Golden parachute. Merger or acquisition. Objectivity during buyouts. Golden handcuffs. Staying with the firm. Retention. Golden handshake. Retirement or separation. Smooth/quiet exit. Golden hello. Hiring/onboarding. Attraction and buyout. Golden boot. Early retirement. Workforce reduction. Study note. When evaluating these for compliance, remember that the Dodd-Frank Act requires public companies to allow shareholders a non-binding say-on-pay vote on these types of executive packages. Global compensation strategy. When managing rewards across borders, you must decide how to handle pay for expatriates. Balance sheet approach. The most common. It ensures the expatriate's standard of living is the same as it was in their home country. The company pays for the difference in cost of living, taxes, and housing. Host country-based localization. The expatriate is paid similarly to local employees in the host country. This is cheaper for the company, but can make it hard to find volunteers for high-cost cities. Global market pricing. A single pay scale for certain high-level roles, regardless of location. Compensation philosophies for business life cycles. Stage, strategic goal, compensation mix, introduction, survival and innovation, low base pay, high equity/stock options, high risk/high reward, growth, scale and market share, competitive base pay, high variable/sales incentives to drive growth, maturity, efficiency and profit, market median base pay, focus on benefits and retention bonuses, decline, cost control, freeze base pay, shift to stay bonuses, for critical talent, during reorganization. Psychological contract and relational rewards. Total rewards isn't just a spreadsheet. It includes the unwritten agreement between employer and employee, relational rewards. Non-monetary things like autonomy, mastery, and purpose, often called the intrinsic motivators, flexible work arrangements. Telecommuting, compressed work weeks, and flex time are increasingly seen as high-value total rewards components that cost the company very little but offer high perceived value. The Employee Value Proposition, EVP. While total rewards is the package the employer offers, the EVP is the why behind it. It is the unique set of offerings, associations, and values to which an employee conforms in return for the skills, capabilities, and experiences they bring to an organization. Strategic alignment. An EVP must be better, different, or cheaper. If you can't pay the most, cheaper labor, your EVP must offer something better, culture, or different, unique flexibility. The 5 pillars of EVP. Rewards, salary, bonuses and benefits. Work, job interest, challenge, and work-life balance. Organization, market position, product quality, and social responsibility. Opportunity, career progression, mentors, and training. People, manager quality, camaraderie, and senior leadership trust. Perquisites, executive relational rewards. At the strategic level, you must understand perquisites, perks. These are non-cash benefits provided to executives to recognize their status and compensate for the high-stress nature of their roles. Common perks. Company cars, specialized insurance, kidnap and ransom, financial counseling, club memberships, and personal use of corporate aircraft. Tax implication. Most perks are considered taxable income to the executive. HR must ensure gross-up payments, where the company pays the taxes on the perk for the executive, are handled correctly and transparently for shareholders. Payroll accounting and internal controls. A senior HR leader must ensure the integrity of the money flowing out of the organization. This falls under governance. Ghost employees. A common fraud, where a fake employee is created in the system and a paycheck is issued. HR must have separation of duties. The person who enters a new hire cannot be the same person who hits submit on payroll. General ledger, GL, mapping. HR must ensure that labor costs are mapped to the correct departments so the CFO can see exactly where the money is going. For example, marketing labor versus R&D labor. Accruals. HR must track and report vacation accruals, the dollar value of all unused PTO that the company would owe employees if they all quit today. This is a liability on the balance sheet. International Social Security and Totalization Agreements. Totalization agreements. These are treaties between the US and other countries to prevent double taxation on Social Security. The rule: without these, an expat might pay into both the US Social Security system and the host country's system simultaneously. Totalization agreements decide which country gets the credit and the cash, based on the length of the assignment. Compensation for contingent workers. As the gig economy grows, the exam focuses on how to reward people who aren't traditional employees. Independent contractors. They do not receive benefits or have taxes withheld. If HR provides them with total rewards, like health insurance or 401k, the IRS may reclassify them as employees, leading to massive back tax penalties. Strategic risk. Managing a blended workforce, where contractors work alongside employees, requires HR to ensure the relational rewards, culture/inclusion, are high enough to keep them engaged, without triggering joint employer legal risks. Benefit plan, financing models. How does the company actually pay for the health insurance? Fully insured. The company pays a premium to an insurance carrier, like Blue Cross. The carrier takes the risk. Self-funded, self-insured. The company acts as its own insurance company. They pay the claims themselves. Benefit. It saves the profit margin the insurance company would take, but the company takes on the financial risk of a catastrophic illness. Stop-loss insurance. A backup policy for self-funded companies that kicks in if a single employee's claims exceed a certain amount, for example, $100,000.